Hello everybody. Today we're going to talk about mortgage insurance. What it means, why do we have it, how does it benefit you if it does at all. So here we go. So when I talk about mortgage insurance, I'm not talking about an insurance product that you usually will get mail about after you buy a home that says, hey, here's a life insurance policy that will at least cover the amount of your mortgage if you die. That's also kind of called mortgage insurance, but that's not what I'm talking about. What I'm talking about is mortgage insurance that you have on your home loan when you are putting less than 20% down, or if you're just using FHA financing. So FHA has a mandatory amount of mortgage insurance that's on there. And what mortgage insurance does is it protects the lender from default if you stop paying your mortgage and your property goes into foreclosure and the bank loses money on it because you're not paying it and they have to sell it off. They have an insurance policy to help cover that loss. So that's what mortgage insurance is, and it's different for the different loan products. But it's a unique feature because it sounds like it's something that's going to benefit you as the consumer, the buyer, the person purchasing the home. But it's actually something you're paying for that's protecting the lender. And that's because you're not putting down enough money. You're not putting enough in there for them to feel safe with what they're doing with lending you the money. And then with conventional financing, you have to put 20% down on that purchase price. 20% of it has to be money out of your pocket in order to not have any mortgage insurance. Now, if you put any amount less than that, there's certain percentages of coverage that you have to have on your loan. So if you put 15% down, it's going to be a small amount. If you put 10% down, it'll be a little more. 5%, 3%, usually those are going to be higher amounts that you're going to pay each month. That's going out as a part of your total monthly payment that's going to your mortgage insurance payment. Now with FHA, it's a standard number. Unless you put more than 3.5% down, then it drops just about 0.05%. It's very small. Now this can be a saving grace if you don't have the greatest FICO scores, because it's very FICO score driven. With FHA, it can kind of help you a little bit. With conventional, if you have great FICO scores, that mortgage insurance number can be pretty low. When I bought my home, our scores were in a great spot. I used conventional financing. I put 5% down. My mortgage insurance, I think, only ended up being like maybe $40 a month or something like that. So it also depends on how much house you're buying, which is to say your purchase price. If you're buying $300,000, $400,000, $500,000, it's going to be more because it's a percentage. It'll be more per month, but the better your FICO scores are, the lower that number will be. The more you put down, but not all the way to 20%, it'll be less. So there's some things there. Now here's something interesting too. With conventional financing, there are mortgage insurance companies. These are companies that provide mortgage insurance, and they're all in competition with each other. So that's also one of those things that kind of helps with the different rates of it. But you have Arch, National, Genworth. You've got all these different companies that are fighting for your loan. They want to be the ones to do the insurance on it. So they will typically they will compete with each other, and they will usually have really good rates on your mortgage insurance. And that's something that you're never going to have to deal with as a buyer. You're as a consumer, as a borrower. You're not going to have to pick those companies. What happens is your loan officer or their team is going to usually price out your deal. They're going to look at your scenario, and they're going to price it out against all of them. They're going to do it all at the same time. They're going to say, okay, what does Radian offer? What is Genworth? What is National, Arch? There's all these different companies. Who provides the best or the lowest or the best coverage for my client? And usually they'll pick that one. And that's usually how it gets done. So it's not something you have to worry about picking or doing so on yourself. It's not like your homeowner's insurance where you have to shop for that and get that set up and get that going during your purchase. You get to shop for that. But when it comes to the mortgage insurance, that's what it is. So I get that question a lot. What is mortgage insurance? Why is it different from my homeowner's insurance? And that's what it is. It's whose is it insuring against what? Mortgage insurance insures the lender against default if you stop making your payments and the house goes to foreclosure or short sale or whatever the case may be. Homeowner's insurance is your insurance policy that covers your house in the event of flooding, well, maybe not even flooding, but fire, damage to your home, even robbery depending on your policy. That's all stuff for insurance agents to go over with you. But that's the difference between those insurances. So with FHA, it's a good deal usually if your FICOs aren't that great. If you're going conventional, the stronger your FICOs, usually the cheaper that mortgage insurance is going to be. The awesome thing with conventional financing too, I forgot to mention, is once you have enough equity, usually about 22%, it'll automatically drop your mortgage insurance right off. That'll just fall out of your payment. If your house appreciates at a pretty good steady clip and you're paying your mortgage as you have to every month, you might reach that point sooner. If you feel like you have at least 20% equity in your property, at least 20%, you can contact your servicer and ask them, can you drop my mortgage insurance? I think I have enough equity. And depending on who your servicer is, whoever you're making your payment to, they might look at it and say, okay, we might do an appraisal, we might do some automated things so we don't have to do an appraisal, but we'll see where you are. And if you're in a good spot and you've already been paying for it, I think it's at least 2 to 3 years, depending on your product, they might just drop it for you. With FHA, it kind of sticks with the loan and it just stays there for a long time. It's supposed to be for the life of the loan, but those rules kind of change from year to year. When I got in the business, it was a different rate for a different amount of time and it would fall off. And then they changed it to be for the entire length of the loan at a different rate, and then they changed that rate again. So that's something that does change every few years, really, it changes. So your loan officer will tell you more about that if you're looking at those products. But those are the kind of the ins and outs of mortgage insurance. So if you have any questions about it or anything pops up in your mind or you've seen it before, comment down below. If you have any questions in general about mortgages or what you should know about when you're looking to buy a home or what you should look for, leave a comment. Let's start a dialogue. I'm sure any question you have will be a question that someone else will probably have coming down the line, and it'll help them as well as help you, and I'll respond to it. So thank you, and yeah, leave a like on the video if you did, subscribe if you haven't, and we'll catch you next time. All right, peace.